The Creature from Jekyll Island by G. Edward Griffin, page 116. Mexico. By 1982, almost every third world government was running behind in payments. Mexico led the way by announcing it could not send any more money that year on its $85 billion debt. Federal Reserve Governor Henry Wallace rushed to Switzerland to negotiate an IMF loan of $4.5 billion through the Bank of International Settlements. The central banks of Europe and Japan provided $1.85 billion, about 40%. The rest came from the Federal Reserve. Commercial banks postponed payments on the principal for 2 years, but with the infusion of new loans, payment on the interest was resumed. That did not solve the problem. Within a few years, Mexico was in arrears again, and in 1985 the banks agreed to postpone $29 billion in payments and rolled over another $20 billion, which means they issued new loans to pay off the old. In that same year, Secretary of the Treasury James Baker announced the government's plans to solve the world's debt crisis. It was a formal statement encouraging banks to continue lending to third world governments provided they promised to enact economic reforms favoring a free market. It was more of a philosophy than a plan, because there was no hope that it would be implemented by any of the socialist governments receiving the loans. Behind the announcement was the implication that the federal government, acting through the Federal Reserve System, could be counted on to assist if the loans went sour. Baker called for funneling $29 billion over 3 years primarily to Latin American countries, of which Mexico was a prime recipient. Currency swap. Shortly after the Mexican government had loaned $55 million to Fidel Castro, it announced to the banks, we will pay only what we have and no more. Whereupon Paul Volcker, head of the Federal Reserve, rushed to meet with Mexico's finance minister, Jesus Silva Herzog, and offered to put the American taxpayer into the breach. A $600 million short-term loan was extended to get Mexico past its election date of July the 4th. It was called a currency swap because Mexico exchanged an equal number of pesos, which it promised to redeem in U.S. dollars. Pesos, of course, were worthless in international markets, which is the reason Mexico wanted the dollars. The importance of this loan was not its size, nor even the question of repayment. It was the manner in which it was made. First, it was made by the Federal Reserve directly, acting as a central bank for Mexico, not the U.S. And secondly, it was done almost in total secrecy. William Grider gives the details. The currency swap had another disadvantage. They could be done secretly. Volcker discreetly informed both the administration and the key congressional chairman, and none objected. But the public reporting of currency swaps was required only every quarter, so the emergency loan from the Fed could not be disclosed for 3 or 4 months. By that time, Volcker hoped Mexico would be arranging more substantial new financing from the IMF. The foreign assistance was done as discreetly as possible to avoid setting off a panic, but also to avoid domestic political controversy, bailing out Mexico. It seemed was too grave to be controversial. That is a piece of history and a disturbing situation. But the fact of this video is that any declaration that Cuba was able to stand on its own as a socialist government in the 1980s, the Soviet Union was still in existence then, and Cuba did have assets. They were agricultural. They have sugar and tobacco for sale. But if they got $55 million through a backdoor loan from Mexico, when Mexico couldn't pay off their loans to us, that was just money looping around from the U.S. straight to Cuba, even though there was an embargo and no relations between the two countries. So anybody that says that Cuba could stand on its own or was a viable government in the 1980s they have this to answer for.